If you are sick and tired of these high interest rates that seem to be keeping people out of their homes, if home buying is a goal of yours and you want to find out, is there any way to be able to afford it these days? Well, you're absolutely going to want to stay tuned to this video where we are going to be going over one of the easiest and best programs to have the seller pay part of your mortgage for you, so stay tuned. What's up, guys? This is Brian Elder, your favorite Phoenix area realtor, and on this channel we talk about all things Arizona homeownership. We're going to talk about the best places to live, best places to eat, sleep, work, play, all that fun stuff. But today we're going over a topic that is super popular right now. I get questions from a lot of different buyers. What are some options to get my interest rate down? Interest rates are really the bugaboo issue when it comes to home buying right now. So I brought in my good friend Blake Hallam. He is a local lender here in the Phoenix Metro. Blake, thanks for coming in.
Yeah, thanks for having me.
Absolutely. So today, tell us a little bit about what we're going to be talking about. As I said, this is a program that you as the buyer can have the seller pay part of your mortgage for you. Tell us a little bit more about this famous buy-down program that's going on.
Yeah, so the one that we're going to be talking about today is a program called a temporary buy-down, right? So you'll see them posted on Facebook, Instagram as a 2-1-3-2-1. Essentially what it is it's a technique that us, the lender, use to collect funds up front from the seller, sometimes by the lender, but more often the seller, to help subsidize your mortgage payment. So you hit it on the head. The seller is actually prepaying a portion of your mortgage payment for you.
It's a wonderful program, and a lot of people have heard of it, I think, but don't really know a lot about it. So tell us maybe a little bit how this differs from what maybe people are a little more familiar with, and those are the points, right?
Yeah.
When you come in, you pay a point, and it buys down your interest rate.
Sure.
What's kind of the difference between that program and what they're doing with these?
Yeah, so a big difference is obviously since it's on a temporary basis, you're going to have way more bang for your buck with these temporary buy downs. So let's talk about a 2-1, for example. A 2-1, it costs 2.25 points in order to do a 2-1. So let's take that 2 points and let's really dive into that. Typically 2 points, if you're going for a fixed and a permanent buy down, 2 points might buy down your interest rate 0.5 point. And for most people, 0.5 point. Now, point being that would be 0.5% on the interest rate. That's going to make a difference. It might make a difference of $100. It might make a difference of 130, 140, depending on the loan amount. But it's not going to make the difference that we see with these temporary buy downs. And the reason for that is when we're talking a 2-1 buy down, for the first year, your interest rate is going to be a full 2% interest rate reduction. So if your note rate would be 6.5, for the first year, your interest rate's going to be effectively 4.5, which is going to end up saving you hundreds and hundreds of dollars every single month.
And the best part that I think there is, and what people don't always realize, is that this is all coming from the seller.
Correct.
Right? We're negotiating this out with the seller. So they're going to be paying this at closing as a credit to you, the buyer. So this doesn't cost you a thing.
Yeah. And there's another point of that too. So a lot of people, when I pitch this to my clients, and I say, hey, we're going to do this 2-1 buy down, your interest rate's going to be 2% lower for the first year. They almost jump to the assumption that this is going to cost them money, or sure, it's going to be 2% lower, but I'm sure you're increasing that note rate up or something, to kind of pay for it.
What's the catch?
Exactly. Here's the best part of it. There's truly no catch. So if your note rate is going to be 6.5, that's the interest rate that you're going to get through this program. So effectively, whatever the going rate is your note rate for this program. But since it's prepaid by the seller, you get those savings and you get that amount that we help subsidize your mortgage payment with. So it truly costs the buyer nothing.
So for maybe those people who are unfamiliar, take us through what a point actually means when it comes to mortgage speak.
Sure. So and there's two ways to kind of think about this. So a point is a fee charged by your lender for your interest rate. So 1 point equals 1% of the loan amount. So let's say, for example, your loan amount is going to be $300,000. 1 point is $3,000. So super easy math there. So when we're talking about points with the 2-1, we're charging 2.5. So let's use that $300,000. It's going to cost a little over $6,000. But what's nice is that's how much you're going to be saving in those 2 years period. It's pretty astounding.
Absolutely. So take us through a little bit of, you mentioned there's the 3-2-1, the 2-1. What are the types of buy downs that are currently available?
Yeah, so 2-1's the most popular. Reason for it is in this market, getting 2 points, 2.25. It's not far-fetched, right? It's almost the standard in today's market to get a couple of points from the seller in most situations. And also, there's no restrictions. You can usually get 2 points from the seller with all loan types, right? FHA, you can get it. VA, no problem. Conventional. The 3-2-1 is probably the next popular one because the savings are so dramatic. The tricky part with that, though, with 3-2-1 is it costs over 4 points. And then sometimes you have seller contribution like limits that
right.
you have that you get capped out by. So, for example, if you're putting 10% down or 20% down or more, 3-2-1 is a great option. If you're putting less than 10% down, you're probably going to get stuck with a 2-1 unless you're going a government loan, so VA or FHA, in which case you can get those 3-2-1. Those are by far the most popular. There you'll see other ones, some 1-1s or whatever. 2-1 gets you the best bang for the buck, and in most cases, it's feasible for the sellers to cover that.
And another thing that I've run into a little bit too, in talking with some clients who are looking at listings on their own, they'll see these seller concessions advertised, 2.5% if you use the seller's preferred lender.
Yeah.
And one thing that I'm always telling those guys is you don't have to use anybody. This isn't a special program that only a few people have access to.
Yeah.
This can be done through any lender that you are comfortable working with. So it's not like you have to use whoever the seller's trying to push you towards, whether it's one of the iBuyers. I believe it was an offer pad listing that this guy was looking at. So you can use any lender you want. You're not pigeonholed with anybody. And it's a great deal. So maybe what are some common misconceptions that you see when people are talking to you about these things?
Yeah, the biggest one is, first and foremost, that it's an ARM, right? So an ARM being an adjustable rate mortgage. This isn't. It's a fixed rate. So as I said, if your interest rate or your note rate is, let's just say, 6.5%. After those, so if you do a 2-1, that means your payment is going to be lower for those 2 years. At the end of that, your interest rate doesn't continue to go up. Your payment doesn't continue to go up. It's locked in at 6.5. So here's probably the coolest part is if you can refinance it before, so let's say we lock in a note rate at 6.5 and interest rates drop down, because this goes into the next biggest misconception on it. You can refinance it at any time. So the second the interest rates drop down, so let's say they drop down to the 5s, there's a good opportunity at that point to refinance it. So it's a fixed rate mortgage, so the interest rate doesn't change over time. And second, you can refinance at any time that it makes sense for you to.
And one of the cool things that you were telling me when we were discussing this the other day, kind of getting ready to make this video, was when you refinance, that money is still yours, right? If rates drop in the next 5 or 6 months, which a lot of us expect them to do that, then it's not like you're losing the benefit, because that money that was paid by the seller basically goes right back into your pocket.
It's the best part of this type of program, and it's why I always tell people it's really a win-win-win, right? I pitch this to listing agents all the time, because a lot of them say, well, I don't want to go that route because then my sellers are losing money. And it's like, sure, but the seller's paying for it. But think about it like this, right? You could potentially get into a whole nother drove of buyers because you're essentially selling the house. Maybe that's priced at $500,000 for a payment similar to a house that's being sold in some cases for $400,000 to $425,000. So you're getting those buyers who are comfortable with those payments at a much higher price point. So you as the seller, you're getting more buyers to come in and look at the property. That's for the listing agent, right? For everybody else, you're able to get that payment at such a lower volume that it really makes sense. But again, moving forward, and as you said, when you refinance the loan, you hit on the head. All that money is yours, and that's the biggest difference between buying points and then buying this temporary buy down. Is that money, the second that you refinance it, that's your money. So that goes actually towards the principal of your loan, or it can pay for a potential future refinance if you want to buy points at that time.
So yeah, there really is. So my next question on here is, what are the main drawbacks to doing a buy down, if any?
Yeah, there's none. as long as the seller pays for it. There's another common thing. So you might be seeing like, hey, a lender offers a complimentary 1-0 buy down, right? Which is, you're starting to see that kind of trickle in. And what that is a 1-0 buy down. Costs about a point. And what the lender will do is they will actually put that point, they'll increase your interest rate to cover that. So it's kind of like when I said it really doesn't, exactly. Right. So that's kind of the catch there, right? So the lender might cover that, but the way that they're going to cover it is by jacking up your note rate. So at the end of that year, your payment will be higher than if you didn't take part of this. If the seller covers it, there's really no drawback.
And it just seems like the perfect time to do something like this, right?
Yeah.
The market right now is starting to tip a little bit back towards, for a while we were in this crazy seller's market where they were getting anything and buyers were just completely at the mercy of what sellers wanted.
Right.
Last year the rates go up and it completely flipped it on its head. And then buyers were the ones dictating the terms almost 100%.
Correct.
We're far more balanced now, right? The last two homes that I've gotten under contract each had competing offers.
Yep.
So we were starting to see more of those multiple offer situations coming back a little bit. So this program isn't going to be around forever. And sellers are not going to be willing to do this all that long term. And especially, again, if rates dip, as we said, those are going to go away. But really, if you can do it, it seems like the perfect time because you first and foremost have to qualify at the high interest rate anyway. So,
Correct.
I mean, if you can't qualify for that, then even with the buy down, it doesn't really do much for you. So obviously that's no good. But if you do qualify for it, as you mentioned, it seems like it's a winning situation no matter which way you look at it because one of three things is going to happen. Rates are either going to be flat, in which case you got in all right at the perfect time.
Right.
They're going to go up, which if they do, great. You still got locked in at the lower rate. And if they go down, you refinance right out of it and put that money back in your own pocket.
Yeah, and that's your first scenario is one of my favorite parts of this, right? So, and I get asked this all the time, right? Well, if I buy now, is it a good time to buy now knowing that interest rates are going to go down in the future? And I always say yes. And the reason for it is because with this program, the likelihood of being able to refinance is extremely high, right? Say interest rates stay the same. Say they stay 6.5 for the next 4 years. The cool thing is you have a fantastic vamping period up to whatever your long-term payment's going to be, right? Because the first year it's 2% lower, the next year it's 1% lower. Okay, you've had 2 years to adjust to the payment. You've had 2 years to kind of get you accustomed to budgeting for that payment. Well, congratulations. Now the next jump up is only $300 per month, right? And then, we'll go on with whatever interest rates are until they do drop down, which they will within the next couple of years for sure. But I always say there's really no bad way to look at it because like you said, if they go down, you have a paid for refinance. If they stay the same, you have that kind of increasing period to step up to that payment. And if they go up, congratulations, it's a fixed payment or it's a fixed interest rate. That's not going to go up once this program expires.
Yeah, and really, honestly, for what we're doing with this video, I don't think we're really talking to the people who are like, oh, am I on the fence about buying or not? Really, this is just more if you are, looking to get past that interest rate hurdle. And you qualify for it, but you're just not sure if you're comfortable making that payment yet. This is the perfect route for folks in that situation because it gives them, like you said, that ramp up period to get used to that higher payment. Hopefully their wages increase over that time as well. But the other nice thing too, as you mentioned, people ask, well, what happens, if interest rates drop? Well, that's a good thing because if interest rates drop, guess what? The price of houses is going to shoot back up because there's going to be more buyer activity and that drives prices up. So you can always fix the interest rate. You cannot fix what you paid for that house.
Correct.
So anything else to add, Blake, about these programs before we wrap it up?
Well, I don't think so. I think we hit it on the head.
Perfect. Well, Blake, thanks again. It's always good to have you in for these discussions. And if you are looking to move to the Phoenix area and you need a mortgage, Blake is your guy. So please check down in the description below. I'm going to have all his contact information and a link to his website so that you can get a hold of him if you need to. Also check down there for the free Arizona relocation guide that I have available to you. I also have created a new dream home questionnaire. Phoenix is a huge area. There's more than 5 million people that live here. So check down there and fill fill out that questionnaire. It will give me some information to help recommend some areas within the valley that you should look into calling home. Thank you so much for watching. We do appreciate it. Please like and subscribe to the channel again if you found this helpful. And we will be back here in another week or so with the second part of our Helping Homebuyers series video that's going to help you get the information you need to get into the perfect home for you and your own situation.